Greetings to you all accountants all over the world. This is Sir Jeff presenting another series again on International Accounting Standard number 10. So those who want to contact me for your lessons for Cambridge and Zimsec, you can actually use that number that is appearing on your screen. You can also use my email. We can talk from there. So let's kickstart today's business. We want to cover International Accounting Standard number 10. International Accounting Standard number what? Number 10. What are our learning objectives today? We want to distinguish between adjusting events and non-adjusting events after the reporting date. Then we want to state and explain explain items requiring separate disclosure, including the accounting treatment and disclosure requirements. Okay, that's what we are expected to know. So, but first of all, we need to understand one thing. We need to understand this concept. I think this is a very critical concept that we need to understand in accounting. Okay, we need to understand this concept, the accounting calendar. Okay, the accounting what? Calendar. The accounting calendar is very important as we try to understand adjusting and non-adjusting events. We are saying a calendar period usually it's, let's say this is 2020, this is 2018. Okay, so your accounting period will start from January. Okay, I think it's very clear. It will start from January and it will end where? It will end in December. So this whole period, okay, this whole period, we are saying we have got transactions that are taking place. Okay, we've got what? Transactions, okay, that are taking place during this what? This period. Okay, then at 31 December, this is our reporting date. We will refer it as RD as our reporting date. That's where we prepare the final accounts, and we agree that on our final accounts we have got the income statements are prepared there. We've got our statement of financial positions prepared there. At 31 December, we've got a statement of statement of cash flows are prepared there. Then our statement of changes in equity is also prepared there. Our statement of changes in equity, our notes to the financial statements, they will be there. So this is our year end. Okay, at our year end, we have got the accountant preparing the books, but there will be some events after the reporting day. These are what we are referring as to adjusting and non-adjusting events that will take place after the accounts have been prepared. The question is, okay, there's another date that is very critical, is the issue date. Okay, the date of authorization, the issue date. Remember, we are supposed to report to our stakeholders, to the general public. Okay, we have the public. They need maybe it's a public limited company. We are supposed to publish our accounts. So we are saying the issue date to the shareholders is 28 February. Let's say that's where we are supposed to publish our accounts. Okay, then it means, what do we do then with the events? Let's say a major customer, in this case, we have got a customer written off. Okay, let's say we've got a major customer. Our books are indicating that we have got another customer owing us $200,000. Okay, and is reported to be bankrupt. What do we do with this customer? Okay, our books may be at 31 December indicating that the customer, we had a data of how much? $2,000, and at the end of the year, just soon after 31 December, let's say on 1 January, we are told, and there is sufficient evidence that the customer owing us 200,000 is gone broke. Okay, is wearing an insolvent jacket. What we do? That's the question. Let's say then after 31 December, there is fire. Okay, there is occurrence of what? There is occurrence of fire. What do we do when there is fire? Then this fire destroyed stock worthy, let's say 200,000 again. What do we do out to our closing stock? That is our closing inventory that is in the SFP. That's the question. That's the question that we want trying to answer. So at the end of the day, we have the guidance from IAS10 to guide us whether to adjust or not adjust. That's the major topic that we want to cover today: adjusting events and non-adjusting what? events. Okay, I think you are actually following. Let's move on to the definition of the two events. So we are saying from my presentation, I think it's very loud and clear that we have got two events. At the reporting date, we have got two events that can occur. Okay, before the accounts are published or before the authorization date, there are two events that can occur. Number one, we've got adjusting events. On our left-hand side, you can see that we have got what we call adjusting events. Okay, then we've got what we call the non-adjusting events on the right-hand side. So there are two events that will occur after 31 December, after the reporting date. There are two events. Number one, adjusting events and non-adjusting events. Okay, let's have examples of adjusting events. We've got a bankruptcy of a major customer after the reporting date. RD is for reporting a debt. Okay, I think you're reporting this, our reporting debt, reporting, okay, debt. Okay, okay, RD. So for the meantime, or when you see RD, I'm referring to the reporting debt. So let's say our customer that was owing us 200,000 and we are told on 1 January that the customer has gone broke, is bankrupt. We are supposed to go back to our financial statements and then we are supposed to adjust for that. Okay, then inventory sold at a loss after the reporting date. This is actually showing evidence that the inventory during the year was obsolete, or somehow it had get damaged. Okay, so it's an adjusting event. Then we have got another one, the property gets impaired weeks after a reporting date. This is also an adjusting event. Okay, then on non-adjusting events, we've got inventory sold at a loss just because we're damaged after year end. It was damaged after year end. This inventory was damaged after year end, so we are not supposed to adjust our books in the financial statements. Let's have another non-adjusting event, impairment of non-current assets, e.g. property due to fall in market values, generally post year end. No, this is not an adjusting event. Why? We are saying this is evidence that the property was fine at the year end, so no adjustment is required in the books of accounts. Okay, so I think this is very clear to us. We need to maybe to get more details, the notes that you need to take down. What are adjusting events? We agree that these are events that provide what? They provide evidence. These are events that provide what? Evidence, the V11s, okay? They provide the V11 evidence, okay? I think in Zimbabwe we are very familiar with the V11. They provide the evidence of conditions that existed when at the balance sheet date, which we are referring as the reporting date. Okay, so adjusting events, what's the definition? These are events that provide evidence of conditions that existed at the balance date. Let's say a customer going bankrupt after the reporting date. It shows that the customer was broke, but the information didn't just come across. We didn't just come across that information, so that is an adjusting event. So we have got property gets impaired. I think property gets impaired weeks after reporting date. This is evidence that the property was impaired. Then discovery of fraud or error in the year end. That is also an adjusting event. The settling of a purchase price for an asset that was bought before year end. This is the key term there. The asset was bought before year end, but the price was not finalized. The price was not finalized. So it means if the price was finalized, then we need to adjust. So we need to adjust in such a case. Okay. So these are examples. Property gets impairment of property weeks after reporting date. It's an adjusting event. Discovery of fraud and error during the year, soon after year end. That's evidence that this condition was there. Then the settling of purchase price of an asset that was bought before year end, but the price was finalized after the year end. It's an adjusting event. Okay, let's move on to non-adjusting events. Non-adjusting events are events that occur after, okay, that after the reporting date, which do not give what? Which do not give the V11, okay, which do not give evidence, which do not give what? Evidence of what? Conditions that were in existence. It do not give evidence of conditions in existence at the year end, but we are saying non-adjusting events are usually indicative of conditions after the reporting date. They are what? Indicative of conditions after the reporting date. Let me show you an example of a condition that is indicative, that is very clear in this. Let's use my third example. Let's use my third example. Destruction of what? Destruction of an asset by fire. Okay, by fire or similar post-year end. If the stock, let's say the stock was destroyed by fire, okay, by fire, let's say the stock of how much? Let's say we had a stock of what? Of $10,000. This stock was destroyed after 31 December, all right? Then are we supposed to go and correct our closing stock at 31 December? No. Why? Because we're saying there wasn't fire at 31 December, but this fire occurred later on after the reporting date. So we are not supposed to go back and adjust. So we call it a non-adjusting event. Okay, let's use example 2. A formal plan issued post year end to discontinue a major operation. A formal plan issued post year end, after year end, to discontinue a major operation. This is a non-adjusting event. We cannot, there is no evidence that there was a formal plan to discontinue major operations. So it's a non-adjusting event. Then the acquisition and disposal of a subsidiary post year end, that's a non-adjusting event. That event took place later on after the reporting date. Then we've got proposed dividends. Remember, proposed dividends, these are rewards given to shareholders after purchasing shares. So the directors might have proposed a dividend, but remember what happened to these dividends now? They are approved. Remember, the owners of the company are shareholders. They approve it on the annual general meeting. So at year end, 31 December, it means these dividends would not have been finalized. Okay, so even if they are finalized after year end, it's a non-adjusting event. It's a non-adjusting event. Okay, let me get to some of the papers that you take. We've got Cambridge past examination paper 2015. A limited company is a financial year end of 31 December 2014, right? 31 December. Okay, I think you can actually see it's very clear our reporting date. Okay, our RD reporting date is 31 December 2004. The following information is available. What happened? Remember, okay, what happened here is on the 2nd of what? On the 2nd of January 2015. Take note of the dates, 2015, and we are talking of 2014 as our reporting date. A fire in the warehouse destroyed half of the total inventory. Half of the total inventory was destroyed. Do we on our notes, did I say this is fire? Fire, what did I say? Reporting date. Do we go back and adjust the books? Okay, thank you. That's a very correct answer. We do not adjust. So this is a non-adjusting event. So we go where it's written a non-adjusting event. We assume this answer can be very correct because there was no evidence that there was fire at 31 December. This fire occurred 2nd of January 2015. So it's a non-adjusting event. Okay, so we are assuming that C and D might be correct. Then on 5 January 2015, a major share issue took place. Okay, this is a major share issue. In as much as it is a major share issue, I know it will change our share capital and so on, but it occurred when there is no evidence that this condition was in existence at what? At 31 December 2004. So this becomes also a non-adjusting event. So it's a non-adjusting event. So we are going to get this D. Then we confirm that our answer in this case would be D, and that's how we handle this one. Okay. This is, you can check your answers if you are not sure of it. Let's move on to another examination. What is Zimsec 2003, 29 October? There was a question again. So this is one of the favorite questions by examiners. So we need to be very particular on this one. Which of the following item is an example of an adjusting event? So the key term there is an adjusting event, an example of an adjusting event. So remember, we said adjusting events, they show evidence of conditions existing at the year end, right? Number 1, loss of stock through fire. We agreed this is a non-adjusting event. So this one, purchase of a new van at the year end. they bought a new van at the year end, so we are not forced. This is a non-adjusting event. We are not forced to go and change our books, right? Then changes in rates of forex. Okay, the exchange rates have just changed. We are not forced to change. Okay, this is a non-adjusting event. Then this one becomes our adjusting event. So I think you can actually see these are some of the favorite questions with the examiner. So what you need to do, you need to prepare, you need to replay the video and try to listen, try to understand adjusting and non-adjusting event. That's very critical. I encourage you to subscribe to our YouTube channel where you can get the latest videos. You need also to subscribe to our Facebook page. And also, if you enroll with us, you have the privilege to get into our YouTube, into our Google Class where we post videos, post current information. Please subscribe to this channel, tell others, inform others about our channel. We are celebrating one of our students who has just graduated in India. We have been with this student for some time and she's done it and we are happy with her. So we want you to achieve whatever you want to achieve in life. But at the end of the day, we wish you all the best in whatever you will be doing. Thank you. We keep on watching everything that will be posted there so that we can